Ticker symbol Halo is up over 40% in the past year, and today we'll be looking at a great company with consistent royalty payments, which has experienced single product explosive growth, with their net income rising over 58% in year over year, and their operating margin being up over 33% as well in the past year. So today we'll be looking at none other than Halozyme Therapeutics, a pharmaceutical company. In their annual report, they reference themselves as a biopharmaceutical company advancing disruptive solutions to improve patient outcomes for emerging and established therapies. They're most commonly known for having developed the enhanced technology with an enzyme which I'm not even going to try to mention. Now, just very basic, an enzyme is a protein which we usually have in our bodies which allows reactions to speed up. In many cases, these enzymes are helpful and even allow us to live. For example, we have a lot of enzymes that their only job is to speed up the rate at which our body is able to break down the food that we eat into useful things that then our body can absorb for us to keep living. Well, Halozyme Therapeutics has managed to develop an enzyme which enables better and faster subcutaneous delivery of drugs. Now, what does subcutaneous mean? I know the pharmaceutical world is full of these complex words, but it basically means inside or under your skin. And the most common way is in injections. So the way they're commercializing this enhanced technology is by reaching agreements with other biopharmaceutical companies in order to improve the delivery and effectiveness of their drug. So for example, a company like Pfizer has a lot of different drugs that have to be injected or which they have to give shots to you in order to actually cure whatever you're going through. Well, a lot of these companies, what they have done is that they pay Halozyme in order to implement their enzyme and mix it with their drug beforehand. This is so when you get the shot or when you get the injection, the whole reaction and the whole mix-up of this drug into your immune system is a lot faster and you're able to get better sooner. This, of course, is groundbreaking because it basically means that these companies' products will be a lot better than their competitors' products. So these companies offer a lot of incentives to Halozyme in order to obtain this product. So this company basically receives licensing fees, milestone payments, and even royalties from such of the biggest pharmaceutical companies in the world, such as Roche, Takeda, Pfizer, Janssen, AbbVie, Eli Lilly, and hundreds more. And the thing is that every single year that goes by, they're increasing their revenues with essentially doing the easy part of the job, which is just giving out their already existing enzyme. And now when we look at their financial analysis, this company is extremely solid. They have a return on capital employed of 30%, which is incredible. And just so you can put this into context, we usually look for companies which have a return on capital employed above 15%, but then their interest coverage ratio of 28 times is above our threshold of 10 times, and their cash conversion is almost 100%. Next, their profit margin is sitting at 84%, and their net margin is a very solid 44%. And over here, our threshold is also usually 15%. So this is a very solid company. And what I like most about this company is this. Just look at the consistency and predictability of their growth. All metrics, revenue, gross profit, and net income are growing. And the great thing is that their fast revenue growth is being further accelerated by an increase and an expansion of gross margin and net margin. Which, come on, this is the perfect combination. If this company keeps going on this way, it's going to be a big winner for sure. And when we look at their efficiency ratios, we can see that they're trending in a very similar direction, with all of them rising consistency and return on invested capital sitting above 30%, which is the one we usually care about from this slide. When we look at their leverage analysis, we can see that in 2023, their total liabilities and their total assets were more or less the same. However, in 2024, they improved their position by increasing their total assets without increasing their total liabilities by that much, improving their current ratio and becoming more attractive to more conservative investors. And when we look at their fundamental analysis, I'm happy to say that this company gets a solid 6.5 out of 8 ticks, as they have low liability risk, as we have seen by their interest coverage ratio. They have a very solid balance sheet as they can pay all of their short-term liabilities only using their current assets, and the cash flow that they generate is extremely consistent, same as their net profit, their gross profit, and their revenues. I'm also happy to say that their organic free cash flow growth is also rising, and that this is mainly being funneled through their organic revenue growth paired with that net margin expansion that we have just seen. This company's shares outstanding is reducing, which basically means that they do conduct some sort of share buybacks here and there. And finally, they have a very strong existing moat or competitive advantage. Why? Well, because they have existing agreements already signed with some of the world's largest pharmaceutical companies in the world, and chances are that this is mainly because these companies are extremely happy with their solution. They generate a very unique advantage for all of these companies. They basically make their product a lot better. And there are a lot of reasons for this existing moat. Starting with number one, which is that their product is patented, meaning that no other provider can actually create their enzyme. It's something that only them can develop. But also, even if there was another competitor, it would be extremely difficult and extremely costly for pharmaceutical companies to change from Halozyme to the second alternative. However, there are a few things I didn't like. Firstly, starting with the fact that they don't pay a dividend, but this could make sense in the fact that they're a very big investor into R&D, and they're actually funneling most of their free cash flow either one, into growing their business, or two, buying back shares, which means that at least they're giving back some of the free cash flow that they generate back to investors. But the second one I believe is a big one, which comes in forms of their pricing power. Now, since the largest portion of the revenues that this company obtains actually come in the form of royalties, which is basically a percentage of the sales that their clients generate. So for example, whenever Pfizer sells one of the products that contains the enhanced enzyme in it, they have to pay Halozyme a percentage of all of the revenues that they actually generated from that sale. However, these contracts are multi-year contracts, and it's extremely difficult to negotiate with these companies and to improve the terms year over year. As I've stated previously, pricing power, in my opinion, is the ability to increase prices above the rate of inflation without losing clients. And I may not be an expert in the industry, but in the case of Halozyme, I see it very difficult for them to be able to increase this percentage or to increase the fees that they take from these agreements or from these partnerships against companies such as Pfizer or Eli Lilly, because of the fact that they're multi-year contracts, so these cannot change, but also due to the fact that these royalty percentages are usually set in stone and very difficult to alter. So it is a very fair point to take into account that a lot of their revenue growth is actually derived from their products of their clients actually doing well. If Pfizer, for example, has a very bad year, well, this could point to a very bad trend for Halozyme's revenues. But when we look at their valuation analysis, we can see that Halozyme does not trade at a very hefty valuation at all. They're currently sitting at a price to earnings ratio just under 18 times, which seems to be at around the average of the past 2 years. However, when we look at their free cash flow yield, they're yielding a 6%, which when we compare it to the 3% long-term inflation rate, it actually deems this company as that it may be at an attractive valuation. And when we look at the risks and possible challenges, again, as with most pharmaceutical companies, the main two risks outlined are, first of all, the possible upcoming regulation changes because of the new administration, which is wanting to change things, implementing tariffs, and even proposing different, first of all, regulation changes, but second of all, cutting government and healthcare expenditure. And the second risk and possible challenges that I do see is them not meeting performance objectives because of what I said. A lot of their growth and a lot of their revenues is out of their control, since it comes in the form of milestone payments or even royalties, which are mainly derived from their clients, all these big pharmaceutical companies, performing at a high level. And now before we move on, please remember that I'm not a financial advisor, so please do your own due diligence. However, I believe that this company has a very good moat, it provides consistent cash flows which are very predictable, and it has a high return on capital employed. So I believe that this could be a good company and maybe a good investment, so I will actually look further into it. Having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.